Hey everyone! It's been about 2 years since we started investing in real estate, and in this video, I wanted to share with you all the pros and cons as well as the returns of short-term versus long-term rentals versus, say, what if I had just put all that money into like an S&P 500 index fund. I know I've done other Airbnb videos, so you might think that I'm going to steer you that way, but I'm not. My goal here is to just give you a comprehensive and neutral framework so that you can decide for yourself which one would work best for your situation. For each option, I will break down the startup cost, the difficulty to get started, the difficulty to maintain, the predictability, any tax advantages, returns, and I will be sharing some actual numbers based on my experience on the cash flow, appreciation, and any other monetary benefits. And then I will end with what I'm doing next and how I would approach this decision making if I were to start as a beginner right now today. Let's first talk about the startup cost. For a short-term rental like an Airbnb or Vrbo, the startup cost is going to be high. There's the furnishing, the licensing. Like for our Florida house, for example, we had to get statewide licensing and then county-wide and then city-wide. There's like 3 different application brackets and obviously 3 different fees to pay. You may be paying for photography, there's lawn care, there's a lot of like maintenance type stuff, and that would be in addition to any initial vacancy that you have to budget for because you take time to set up the place and obviously can't rent it out to anybody at that time. And also a hefty down payment. Now, if you are doing some sort of co-hosting or arbitraging, I personally don't have any experience with that, so I can't comment on those. I would highly encourage you to look up what other startup costs you might incur. For a long-term rental, startup cost is kind of medium. You would still have to purchase the property. There's still a down payment. And of course, there's real estate transactional fees like the closing fee, the appraisal. To list your property for rent, you'll also need photography. You'll have to budget for vacancy in the beginning. So depending on the area you're looking at, this might still be a significant amount. Definitely less than a short-term rental, but still not insignificant. Now for a third option, let's look at what if you just wanted to invest in like broad market index funds. Since you can invest any amount you want, there's not really a barrier of like, this is the minimum you need to purchase, and whatever you're contributing is going straight into that investment instead of some other like spent cost like furnishing. Next, for difficulty to start, I would say short-term rentals are definitely high. Not as in these are very difficult things to do, it just takes a lot of time, and for a lot of us, I'm a full-time pharmacist as a background, these are new skills, learning to analyze a property, learning to design a place, even though I already had some sort of an interest in it. How do I price it? How do I write a listing? What kind of photography would be appealing? How do I market it beyond the standard online platforms? Figuring out the tools I can use to manage remotely, building a team, and if you want a full list of all these different steps, I have a couple of videos that are really relevant to this. Not everyone can fork out time to invest in this, and not everyone wants to even do this. It's a good thing and a bad thing. Bad because you actually have to put in time up front, but good in the sense that most people won't even bother. So there's like naturally a barrier to entry because of how many people wouldn't want to put in the work. For a long-term rental, I would rate the difficulty at medium. You'd still have to learn the real estate market and how to analyze how much a property can make and whether it makes a good investment. You'll have to learn about how to screen for tenants, crafting a lease, what kind of tools can you use to automate rent payments so that you're not like chasing people down, how do you want to coordinate showings, how do you want to take maintenance requests. Again, these are not difficult tasks, but still somewhat of a time investment to learn. Contrast that to putting money into a broad market index fund. There's really not much to learn in the beginning. I suppose you should have a general idea of what the stock market is. Probably should look at the fee structure of whatever fund you're choosing to buy, but that's about it. So I would rate this pretty close to 0. Moving on to difficulty to maintain. Again, short-term rentals is going to be the highest. There's going to be an ongoing investment of time, especially if you self-manage. I'll give you an example. For the past few months, seriously, I've been dealing with this washer and dryer situation where there's like rust that's coming off the washers sometimes into the pillowcases, into the sheets, and we would try cleaning out the gasket, buying a new part to replace the part that looks rusty, trying vinegar, trying bleach, having people look at this part and that part. And throughout this whole process, there was coordination with the cleaners. Are the pillowcases still dirty? Do we need to buy new ones? Coordinating with the handyman. All of this just to finally decide, you know what? It is not worth the hassle, let's just get new machines. Stuff like this isn't particularly fun, and contrasting to like my stocks, they can't call me. I'm not responsible for the day-to-day management, but here, we own the decisions. We have to brainstorm what to do. And even without this like very specific washer dryer situation, there's still kind of the background work of some level of bookkeeping. There's reviewing pricing to make sure we're doing fine. There's communicating with the guests and troubleshooting issues that are big and small that generally require a little bit more immediate attention versus, say, someone at a long-term rental. And one more thing that I'm sharing, and I don't think this affects everyone, but for me at least, it kind of occupies a little bit of my head even when nothing's going on. It feels kind of like I have an internal clock that says, ooh, I haven't had a booking for about a week. Is there something wrong? Or like a curiosity of wanting to know what kind of other listings have showed up in my area. Am I still being competitive? Am I still comparable? I've learned from all of this, so there is value in going through these things. But it was a steep learning curve for a beginner like myself, and it definitely was not passive. As for the long-term rental, I would say that maintenance is fairly easy. If you do a good job upfront screening tenants and you build up a good relationship with them and set very clear expectations for both yourself and for them, and if you automate what you can with the rent collection process, there's really little ongoing work. And the type of work that would be required would be more like, oh, appliances are not working. Ooh, is there water coming into the basement? Should we troubleshoot that? All kind of bigger things that you would be calling someone else to come look at anyway, unless you're like super handy. We are not. And then besides that, every year, every other year, there would be a turnover where you have to relist it, sign a new lease, and occasionally you have to renew your rental license. It's not completely passive, but it's pretty close. For index funds, obviously, very little work, especially if you set up automated contributions from your paycheck or from your bank account that just goes in and buys the same fund over and over and over again. I don't even look at this routinely, it's just happening in the background. Now, let's talk about predictability. Short-term rentals, I feel, are the least predictable and kind of highest risk. At the end of the day, travel is a completely discretionary spending. No matter how special or how unique this place is, people don't have to stay at your vacation rental. People don't have to vacation at all. So demand can change rather quickly, whereas the supply can lag over time because these are the existing places that have already popped up. And so you could see big changes to your occupancy based on all these other external factors, and or you'll have to adjust your daily rate to match the drop in demand. There's also changes to the algorithms that are used by Airbnb and Vrbo, and that is also beyond your control. Regulations can be beyond your control. You can do your best to mitigate risk, but entering into short-term rental, you're kind of accepting that, yeah, you might do really well one year and kind of opposite the next year. In the case of long-term rentals, I'd say the predictability is actually pretty good, barring entire population declines where like everyone moves out of that city and the population drops and drops and drops for years. In general, people need a place to live and there should be a market for renters. And in general also, rent should go up more than the speed of your property taxes going up. A lot of the expenses like the water heater, HVAC, the roof, vacancy insurance, those are things you can kind of budget for over like a number of years. Regarding the stock market, on a day-to-day basis, yeah, there's a huge amount of fluctuation, but taking the long view, which is what we're doing for the real estate stuff, so it seems only fair to also view this in a long-term way. Historically, the stock market has gone up consistently. I would give this the same level of predictability as a long-term rental, but I'm curious to hear your thoughts. Next topic is tax advantages. I think short-term rentals is potentially the most powerful of all three of them because you can take advantage of depreciation of real estate to kind of write off your income. You can take business trips, which are also kind of fun because this is also a vacation home that you can kind of enjoy. Granted, you do have to do some work while you're there for it to be a business trip. I'm not a tax expert, so look up the rules. And if you're in a higher tax bracket, the possibility of using any losses in the short-term rental to offset your other ordinary W-2 income is very appealing. And then when it comes time to sell, you could look into deferring taxes on the gains by doing a 1031 exchange, which means you sell this in exchange for a like-kind property. Or if you're doing this with the purpose of passing it on to the next generation to build generational wealth, your kids get to take the step-up basis, so like the value of the house for their tax basis would be whatever value it is at the time of your death. I know, super morbid. But anyway, this is all stuff I learned from consulting with a couple of CPAs who gave me advice on my situation. I would highly encourage that you seek out proper advice from a real expert who can take a look at your exact circumstances. It's interesting because the two people that I spoke to, they had different opinions as well. So getting multiple ideas is not a bad thing. Now, for long-term rentals from a tax perspective, it's not bad. All the things I said about selling and passing to your kids, that still applies here, as does taking the depreciation of the rental real estate against any income that you make, such that the effective tax rate just from this rental activity is going to be much lower than your normal income. However, because rental real estate is considered passive, you don't get to take any of the losses here against your ordinary work income. And if you're doing this on the side, most likely you can't qualify for real estate professional status, and I really can't find any other way around that. Now for stocks, there's some tax advantages here too. Retirement accounts, either pre-tax or post-tax ones, can minimize your tax burden either now or for the future. Outside of those accounts, if you plan to hold these investments for more than a year, you're also taxed at the lower capital gains rate. So which one of these three is most advantageous from a tax perspective really just depends on your circumstances. Now let's move on to returns, the fun stuff. How much cash flow, like liquid, usable cash money, can you make from this? In general, short-term rentals should have a higher potential for generating a bigger amount of cash flow. Using the beach house as an example, if we were to rent it out as a long-term rental, we would be charging like $5,000 to $6,000 a month, which is a lot of money. And over the course of a year, it would be about $70,000. But as a short-term vacation rental, I'll link the video I did about this where I go into detail. Our revenue goes into the 6 digits. That said, expenses are also higher for a short-term rental. And as I explained in that video, our net for the year for cash flow was only $8,000. It's actually even less this year because our property taxes went up. So high cash flow in absolute terms is not a guarantee. It really is just relatively higher than if you were to do this as a long-term rental for that same property. Cash flow also really depends on the market you choose. We chose a very expensive market with high appreciation but low cash flow, as well as your experience and your skills. Like you could be pricing this wrong, you could be spending too much on maintenance, which is kind of what we did because as a beginner, we made all sorts of operational mistakes and you kind of have to budget for having some of those issues. I'm saying all this not as a complaint or to dissuade anyone from investing. I feel really fortunate to be in this position where I'm talking about making money from a second home and having it for vacations, for our parents' retirements, all the things. But I just really want you to know what you're getting yourself into. Now, long-term rental cash flow is actually pretty good. Our rental, which is valued at like a third or a quarter of what our beach house costs, brings in just as much cash flow as our beach house without all the headaches, without all the day-to-day kind of work. I will caveat that yes, we were helped by low interest rates when we purchased, but for the purpose of this video, I redid the math using today's 7% interest rate. We would still be making $300 to $400 of net cash flow per month, and that is factoring maintenance costs and all the other expenses. Deals like this don't come along every day, so you do have to be very patient. And also, obviously, you have to make sure that the market you're looking at, this is actually possible. Like generally, really expensive markets, this is less likely to happen. You're looking for markets that have a high rent to housing price ratio. Now for stocks, originally I was going to say cash flow was 0 because I don't think of dividends that way, but I suppose technically you could call that cash flow. Feel free to adjust this based on your opinion. Now the second part of returns is the appreciation. And I think this is where the magic of short-term rentals and leverage is. First of all, every month we're contributing to the loan pay down of that mortgage that we have on the house with the help of rental income. And then secondly, over time, the value of our property has gone up. Does it always go up? Of course not. No investment does. But as a whole, it trends in that direction over time. For our beach house, our starting equity was $91,000. And over the past couple years, with loan pay down and with the appreciation of the property, our equity is now more than $300,000 in the same house. Contrasting that to our long-term rental, our starting equity was $45,000, and we still have the advantage of paying down the loan every month, but this is in a slower appreciation kind of market. Our equity in this house after 2-ish years is $75,000, which is still pretty good and perhaps like more balanced between appreciation and cash flow. For stocks, we need to pull out a calculator. On a year-to-year basis, it really fluctuates. And so comparing directly those 2 years, 2022 and 23, that was quite the swing. Historically though, the annualized return for the S&P is about 10%, and a lot of people are very comfortable using the conservative estimate of 7% per year when they're like talking about retirement savings. So if we take how much we put into the long-term rental, $45,000 in a down payment plus another $7,000 in a startup cost and closing fees and licensing, etc. That's $52,000. Plug it into the investment compounding calculator, we would be at $66,769, which is a lower return compared to the rentals. Now, if we redid the math, assuming you're investing in a pre-tax account, for us, we have roughly like a 40% tax rate in Minnesota between state, federal, and also Social Security and Medicare taxes. That $52,000 of post-tax money is really equivalent to like $86,000 of pre-tax money. Stay with me on the math here. And so redoing that same 10% return, that would be actually $110,000 at the end of 2.5 years. A huge difference depending on your tax bracket and whether you had room even to increase your contributions in these pre-tax accounts. Let's quickly talk about other gains and returns. So for the beach house, we got to take a couple of vacations, and I would value these at a total of maybe $15,000 because we did take like the whole family for an extended amount of time and really enjoyed ourselves. There's also a little bit of tax loss that we can claim from the beach house. And then for the stocks, this is not like a return, but kind of a benefit that points me to that direction is that it is so easy, and also because it's the easiest to liquidate. Like if I, in a pinch, absolutely needed money, I know how much is there that says it on the little number on the screen in my account, and how much penalty I will take if I'm pulling from retirement. Like I know how that's gonna work. Versus if I had to liquidate a house, it's gonna take like at least a couple months for the whole transaction to go through. So with all these pros and cons, what's my conclusion? My biggest one is to stay diversified. One investment might be doing better than the rest for 1 year, but then the reverse is true for the next year. And diversification helps spread that risk out. It gives me optionality so that I'm less likely to be suddenly needing money at the wrong time. And as far as how I'm choosing between these three right now, this is not financial advice, really just what I'm doing and how I'm thinking through this. Investing broadly into the stock market via an index fund that is low fees. That is an absolute given. It's just so easy and the returns are solid, especially when I'm taking advantage of tax-advantaged accounts. The main reason for me to deviate from this known path, other than just risk diversification, is to seek higher returns. With real estate, I am trading in my time and effort and a little bit of risk with leverage in exchange for the possibility of higher returns. And so right away, if someone is looking for completely passive income, this is not it. Between long-term and short-term rentals, I am simultaneously looking at both. Long-term is great for how low-key it is. It is great cash flow. And I already know the local market so that I really just need a few minutes every other day to look on Zillow, and I would be able to quickly analyze deals and spot something that would work. I'm choosing not to invest more time into this, into like learning a new market for long-term rentals, because I'm using all of that bandwidth to study short-term rental markets. And right now I'm looking at a location in the Midwest that I think if we can find something that is unique, like not a random house in a residential neighborhood, something that is special and a really good experience for my family, I think it would be fun. It would be enjoyable trips and also a good investment. Knowing that this is a market in the Midwest though, my bar for needing higher cash flow is much more stringent. I need the profit to be much more on a year-to-year basis because I can't be counting on the appreciation as much. Now, if I were completely starting new today, how would I choose between these options? In my mind, stocks are always going to be part of the portfolio, but if I'm saving up for a real estate investment, I would ease up a little bit of how much I'm investing via that route so that I have liquid cash for the real estate investment that I choose. And then between short and long term, I personally went the long term route first because as like a healthcare person who has no business background and I've never done anything like this, there was a lot of doubt in terms of whether I can even do this, whether it's realistic, whether it's going to take too much time, whether I will be able to gain these skills at a reasonable pace. Long term just seemed a little bit more predictable, and something in town was also more manageable, like in case something goes really wrong. And also in the worst case scenario, if it all fails and we just have to sell the property, we would just lose a finite amount of money in the transactional cost of buying and selling real estate. Versus if we were to fail in a short-term rental property that's from far away, it felt like it could have been a bottomless pit where we're like sinking so much into furniture and we're unable to sell. It just sounded like a bigger risk up front for the level of skills that we have. The long-term rental turned out to be successful, which really helped us wrap our head around a bigger investment that is out of town, a bigger purchase, and a little more complex. Now, if long-term was not an option and I want to go straight to short-term rentals, one way you could test it out is if you can rent out a room in your space, or like even help a friend who is interested in renting out their room, help them in the setup process and learn the software, learn how to write listing descriptions, how to take photographs, how to market your listing. Use that as a learning experience. And that's kind of what we did with the backyard tiny house initially. That taught us so many valuable lessons that we carried forward to the next project. I'm curious, what is your approach on all of this? Which one do you think is most useful in your case? And let us know why, because everyone's circumstances are different. And I think it's really helpful to hear different perspectives and understand why different people might land on the different decisions that they land on. Anyway, I hope my perspective and framework was helpful in some way. Please subscribe if you haven't already, and I'll see you again next week. Bye!